There is no doubt about how dangerous it could be if there were any breach in debt ceiling limits. This occurs when governments exceed their approved limits on how much they can borrow, especially for our economy's long-term bank balance along with global markets. Should any unintended event arise, like defaulting on necessary obligations, breaks down confidence that we have effective management skills concerning fiscal management, the disastrous impact will be immediate with skyrocketing interest rates. With credit ratings declining under pressure increases lending costs while banks face reduced profit margins. The volatility in markets and its impact on various sectors. Market instability often comes with uncertainty, which can worsen the situation given banking distress or surpassing the debt ceiling breach. It becomes challenging for corporations to strategize investments and take financial judgments during such times of market volatility. The stock market also tends to experience great fluctuations, which may affect portfolios and retirement savings of those invested. Alongside, sectors that rely on steady funds such as housing or construction may face hindrances in obtaining loans or an increase in borrowing costs. Due to these changes, market volatility could lead to a decline in consumer and investor confidence, slowing down economic growth. The American financial system's significance as the cornerstone of the world economy is as follows. The American financial system is essential to the development of the world economy. For global commerce, investment, and capital flows to occur, the U.S. financial markets must be reliable and stable. The main reserve currency is the dollar, which facilitates cross-border trade. Any interruptions or unrest in the American financial system might have far-reaching effects and have an impact on economies all over the world. Due to the interdependence of the world's financial systems, issues in one nation can swiftly spread to others, creating systemic hazards. Market downgrades and a higher debt-to-GDP ratio are causes for concern. Market downgrades happen when credit rating agencies downgrade their evaluation of the creditworthiness of a borrower. A fall in the U.S.'s credit rating, which would indicate increased risk and undermine investor confidence, could result from exceeding the debt threshold. The government would incur greater borrowing costs as a result of a lower credit rating, which would increase the debt-to-GDP ratio. Concerns about the government's ability to service its debt are heightened by a high debt-to-GDP ratio, which might set off a domino effect of higher borrowing rates, slower economic development, and fiscal difficulties. Segment 2, Regulatory Measures and Supervision. The role of regulators in controlling the banking crisis. Regulators are essential in controlling and reducing the impact of a banking crisis. They oversee and uphold laws that safeguard consumers, encourage financial stability, and guarantee the stability of the banking system. To stop excessive risk-taking, regulators keep an eye on bank operations, run stress tests, and establish capital and liquidity requirements. To maintain market confidence and stability during a crisis, regulators support the liquidity of failing institutions, step in to intervene, and work in tandem with other regulatory bodies. The necessity for regulatory bodies to take thoughtful and futuristic action. To effectively address banking crises, regulatory organizations like the Federal Reserve, Office of the Comptroller of the Currency, and Federal Deposit Insurance Corporation must act thoughtfully and strategically. They should anticipate and recognize new risks, update laws as necessary, and improve supervision techniques. Regulators must support openness, build solid risk management frameworks, and cultivate a compliance culture within financial institutions. The significance of thorough investigations into short selling and collusion, market manipulation, short selling, and collusion can aggravate the situation in times of crisis. To find any wrongdoing and prosecute those responsible, regulators must conduct in-depth investigations. The integrity of the market is protected, and such behavior is discouraged by punishing colluders and market manipulators. Regulators can promote investor confidence and market stability by making sure that markets are fair and transparent. The difficulties supervisors face in striking a balance between regulations and efficient supervision. Finding the ideal balance between regulations and efficient supervision is a challenge for supervisors. Overly strict regulations may make it difficult for banks, especially smaller community banks, to effectively serve their customers by placing heavy compliance burdens on them. In order to ensure that regulations are reasonable, risk-based, and targeted to address particular vulnerabilities, supervisors must take into account the unintended consequences of rule changes. Regular assessments, early risk identification, and prompt problem-solving are all essential components of effective supervision. Segment 3, Balancing Rules and Requirements. On community banks, too many regulations might have the following effects. Community banks, which frequently have fewer resources and incur higher compliance costs than larger institutions, can be disproportionately harmed by excessive regulations. The ability of local financial institutions to lend to small businesses and promote economic growth may be constrained by onerous regulatory requirements that take resources away from supporting local communities. Striking a balance between preserving community banks' ability to play a crucial role in local economies and ensuring financial stability is essential. I'm in favor of having a serious discussion about the effects of adding new laws, rules, and specifications. It is crucial to have thoughtful discussions and conduct in-depth analyses of the potential repercussions of any new rules, regulations, or requirements. The impact on various stakeholders, the costs and benefits, and any potential unintended consequences should all be considered by decision makers. A collaborative strategy involving regulators, industry participants, and other pertinent parties can result in efficient and fair regulations. The demand for a comprehensive strategy that takes into account deposit insurance, capital, liquidity, and other important variables. When creating guidelines and specifications for banks, regulators should take a comprehensive approach. This involves taking into account a number of variables including liquidity, capital adequacy, deposit insurance coverage, risk management procedures, and consumer protection. A robust and stable financial system can be aided by a comprehensive framework that takes into account various aspects of banking operations. In order to prevent unintended negative effects, regulators are urged to carefully consider the unintended consequences of rule changes. Regulation changes may have unintended consequences on how market participants behave and how the financial system functions as a whole. A thorough understanding of potential outcomes and a readiness to make adjustments in light of feedback and practical results are necessary for striking the right balance. Segment 4: Too big to fail and consolidation. Investigating the implications of the idea that banks are too big to fail. The idea that some financial institutions are too big to fail stems from the assumption that, should they fail, the overall economy would suffer severely and a government bailout would be required. Due to the perception that they will likely be bailed out in times of crisis, large banks may take unwarranted risks. Regulations like increased capital and liquidity requirements, living wills, and resolution frameworks are needed to address the problem of banks being too big to fail and ensure that failing institutions can be safely wound down without upsetting the entire financial system. Addressing the banking system's impact on financial consolidation concerns. The trend of banks acquiring or merging with other financial institutions to create larger, more complex organizations is referred to as finance consolidation. Consolidation can result in economies of scale and greater efficiency, but it can also raise issues with systemic risk and the concentration of power. To prevent the creation of institutions that are too big to fail and to maintain competition in the banking sector, regulators must closely monitor consolidation. Both the stability of the banking system and the expansion of community banks can be supported by fair policies. Promoting strong big banks while encouraging the expansion and success of community banks. A balance between sizable, systemically important banks and active community banks is necessary for a sound banking system. Big banks are essential to the delivery of sophisticated financial services, the management of complex risks, and the facilitation of global transactions. Community banks support small businesses, assist local communities, and promote regional economic growth all at the same time. Both types of institutions have value, and regulatory policies should acknowledge this and foster their coexistence and development. Considering the difficulties of serving a variety of clients and the significance of keeping a strong banking system, a wide range of customers, including individuals, small businesses, corporations, and institutional investors, must be catered to by the banking system. Serving such a diverse clientele requires a strong banking system with numerous institutions that can offer specialized services, effectively manage risks, and satisfy shifting market demands. Ensuring financial stability, encouraging competition, and implementing regulations that support innovation are all necessary to maintain a strong banking system while protecting consumer interests and the health of the economy as a whole. Segment 5: The Path Forward and Market Impact, highlighting the significance of a debt ceiling agreement to prevent market panic. For financial stability and to prevent market panic, a debt ceiling agreement must be reached. If the debt ceiling isn't raised or suspended in a timely manner, people may lose faith in the U.S. government's capacity to fulfill its obligations. The financial markets may experience a sharp sell-off as a result, which would have a domino effect on investor sentiment, credit availability, and borrowing costs. A debt ceiling agreement gives the assurance and certainty of the market, which helps avoid unneeded disruptions. Considering the possible repercussions of financial market panic and the irrational decisions it may cause, financial market panic can have serious repercussions. Widespread asset sales, a rise in market volatility, and a move towards safe havens like government bonds can all result from it. Decisions made out of panic are frequently motivated by fear and can lead to irrational behavior, escalating market volatility. These irrational choices could involve making hasty investment decisions, selling assets at distressed prices, or withdrawing money from financial institutions, further destabilizing the system. In order to avoid market turmoil, it is crucial to carefully consider all options and engage in negotiation. Negotiation and careful consideration are crucial to preventing market chaos. Politicians and lawmakers must have productive conversations in order to promptly raise or suspend the debt ceiling. In-depth discussions should center on addressing the underlying fiscal issues and locating long-term solutions to the nation's debt management problems. Policymakers can lessen the potential market impact and inspire confidence in investors and market participants by displaying a commitment to responsible fiscal management. Describing the steps taken by financial institutions to prepare for the potential effects of going over the debt ceiling. Financial institutions typically create backup plans to deal with any consequences of exceeding the debt ceiling. These plans include stress testing their balance sheets, evaluating potential scenarios, and determining the effect on liquidity and capital adequacy. Additionally, institutions may keep adequate cash reserves, diversify their funding sources, and closely watch market developments. Financial institutions can successfully navigate potential disruptions and continue to serve their clients even in difficult market conditions by being proactive and well prepared. In conclusion, the consequences of breaching debt limits and experiencing banking turmoil can have far-reaching effects on the economy and global markets. Skyrocketing interest rates, declining credit ratings, and reduced profit margins for banks are just a few of the immediate impacts. Market instability and volatility can disrupt various sectors, affecting investment strategies, stock market fluctuations, and the availability of funds for sectors like housing and construction. The American financial system's significance as the cornerstone of the world economy cannot be overstated, and any disturbances in its stability can have ripple effects worldwide. Addressing the consequences of breaching debt limits and ensuring a stable banking system requires collaborative efforts, thoughtful regulations, and a focus on maintaining financial stability while supporting economic growth. Thank you for watching Mavericks. If you like this video, do not forget to subscribe to the channel and leave a comment because I always read them and I am interested in what you guys think.